Hi everyone, Mr. H here. This is part 2 of chapter 3.4, Final Accounts. In our previous video, we explained what final accounts are and we discussed a little bit about the interest of each stakeholder in these documents, these statements. We also presented the first of the two documents or final accounts in this chapter, which is the profit and loss account. We explained how to elaborate one. And now we are going to talk about the balance sheet. The balance sheet is a snapshot of the net worth and the financial status of a business at a certain point, usually at the end of the accounting year. So it shows you, in a nutshell, how much the business is worth, okay, in money, but it also shows you a balance between what is owned by the business and how that what is owned was financed, okay. It also includes the liabilities, the debts, or what the business owes. So I'm showing you an example right now. This is an example related to the same previous example. This is ABC Limited, the same business. It's a fictional business, of course. And this says balance sheet as of March 31st, 2020, which is at the end of an accounting year, for example. And it shows you all, I'm going to explain right now each of the parts of this document. Essentially, a balance sheet involves or includes three specific aspects of the business, okay, or the financial situation of the business. It involves the assets, the liabilities, and the equity. I'm going to explain each of these three. Number one, the assets. The assets are, in short, what a business owns, okay, everything that a business owns at that specific moment, okay. It can be classified, it has to be classified into two. First, the fixed assets, which is the long-term possessions, the long-term assets of the business, okay, what it owns for a long term, what it doesn't plan to sell right away, what it plans to keep for a long time. Like, for example, premises, properties, buildings, equipment, I mean, every big tool or machinery that the business buys for production or whatever, and vehicles, for example, too, okay. So it involves of these fixed assets, but also it involves the accumulated depreciation. For IB students, this is an high-level concept that we will discuss after this, but it is important to also consider right now, because every single premise or equipment or vehicle depreciates, it gets older. So it loses value in time. So since it loses value in time, it is important to subtract that depreciation money from the actual value of all the fixed assets. So this is what happens here: fixed asset minus the accumulated depreciation. So we can get the net fixed assets. Then you have the current assets, which is the short-term assets or possessions, which are the ones that can move faster. They have greater mobility than the fixed assets, and this is why they are called current assets. And they are three, basically, which is the cash, the debtors, people or businesses that owe you money, and the stock, materials and goods that weren't sold and that you are keeping in store. They are considered also in terms of money as stock. Then you can get the current assets. The other section of the balance sheet is the liabilities, and then you have the liabilities, which is what you owe, what the business owes, okay. So remember, assets, you own it; liabilities, you owe it. And it also can be understood in two ways. One is the current liabilities, which are the short-term debts that must be paid right away or as soon as possible, like an overdraft, like short or small creditors, like providers or suppliers you have to pay right away from trade credit, or any other short-term loans, okay, like you include here. And then you have the long-term liabilities, which are like the ones that you pay in more than a year, and they can be like bank loans or mortgages, okay. An example is just one single long-term liability, which is here. So they go here, okay. So assets, liabilities, and last but not least, we have the shareholders equity. The shareholders equity can be is also known as shareholders funds, okay. Is how you financed all this, how you made all this possible, and it is basically two, which is the shareholder, the original investment. Okay, it is. I'm sorry, the share capital, the original investment. Okay, is what the owners gave when the business started. Okay, in terms of money. Okay, understood in dollars or in soles or in any other currency, but is what the owners gave when the business started, the original investment. And you also have the retained profit. Something interesting to mention about retained profit, this is not the same as the retained profit in the profit and loss account. Why? Because the one in the profit and loss account shows exactly what you got at the end of a specific accounting year. This retained profit is the accumulated retained profit, the reserves. It what has been kept as retained profit from year to year. So it is understandable that the numbers or the figures here would be greater than the one shown in the profit and loss account, which just talks about that specific year. This is the accumulated retained profit from over the years. Okay, so these are the three most important parts or areas of the balance sheet. And now I'm going to show you quickly how to obtain the values and organize the values of this document. Okay, so let's go back to the top. We said we first focus on the assets. I mean, these are in $1 million. So first the fixed assets. We write the fixed assets here over this column. Then we subtract the accumulated depreciation if it is available, and then we get the net fixed assets going to the second column here as a total value. Okay, so next fixed assets go here. Then you get the current assets. Okay, the current assets are usually sorted or written down in order of liquidity, in order of how fast they can be mobilized, how fast they can be moved in the business activity. So from the one that is the fastest cash up to the lowest. Some examples actually show you these three in the opposite way, starting from the one that moves the least to the one that moves the most. But I mean, that's just style. The idea is like you keep a specific order. So we start with the one that is that moves more, like cash, and then we go on debtors, people or businesses that owe you, and then you go on stock. I mean, as I said, raw materials and or goods that you are keeping in store, and you get the value of these three. You add it, and you get the total current assets, but you keep this number separated. Okay. Then you get the current liabilities. Okay, they are similar. They are also short term, and you include them here, like for example, an overdraft, creditors, other short-term loans, and then you also get the value here. So with these two numbers, you made a calculation. Okay, with these two numbers, you get the net current assets, or also known as the working capital. Okay, so you subtract it. 57 minus $42 million, you get this $15 million. You write it to the second column as a full number. Okay, as a total value here, and it is $50 million, and is the working capital, which is basically the money that we use to keep the business running from day to day. Okay, so this is why it is important to get this number. How do you get it? Again, current assets minus current liabilities. That's how you get the net current assets. Just net current assets. Look at this here. We just got the net fixed assets before. Now we are getting the net current assets. Okay, fixed, current, big values here. Now we get the total assets less the current liabilities, which is another value to remember. How do we get that? We add next fixed asset plus the net current assets, then we get this number here. And now the only value we're missing from liabilities is the long-term ones. So long-term liabilities here, we get the number, and we finally subtract these long-term liabilities from our total assets less current liabilities, and we are getting the net assets, which is the final number of this first section. Okay, so what do? We had the fixed asset first, minus the accumulated depreciation, if available. Then we got separated the current asset minus the current liabilities. We got the current assets here. We got a partial addition, which is the total asset less current liabilities. And then we got subtract the long-term liabilities, which is this $300 million. And we finally got the net assets, which is the final number of this section. The only part that is missing now is just how we financed all this, how we made all this possible. And this is how we get, we said finance by, we include the equity, the shareholders' equity, the share capital, which is this amount, the original investment, and then we add the accumulated retained profit here, and that's how we get the shareholders' funds, the shareholders' equity, and we got the number here. Now, as you can see this, it is easy to realize that there is a relationship between these two numbers. So when these two numbers show to be the same, this means the balance sheet is actually properly made. Okay, so the goal of the balance sheet is that what we have to finance everything, the share capital and the retained profit, must be the same to cover all the net assets, which is all the fixed assets, all the current assets, minus the current liabilities and the long-term liabilities. So these two values have to be the same in order to make sure that we have elaborated a proper balance sheet. So this is how we write down a balance sheet in an IB exam, or even in real life if you want to elaborate your own. This is how all values are organized and placed, put in place, so we can get this balance. Good. Now the balance sheet covers all these assets, but they might not be all the assets of a business. There are some assets that are called intangible assets that would not be included here. Why? For two reasons. Because either because it is impossible to give a monetary value to those assets, or because the monetary value is not that clear. So because of these reasons, these assets are not included, because also they are not usually tangible things, but they are mostly intangible. What are those? Well, goodwill, which is the practices and the good practices, the attributes of a business. They are actually intangible and they have no monetary value, but sometimes we consider them also as part of a business. Again, when we say goodwill, we mean all the good practices of a business. Additionally, we have the patents, which is the rights of inventors to create, keep, create, and produce something they have created. The copyright is also a legal right for creators, okay, to also produce and reproduce and sell specific properties or creations, like artists or musicians. And we have trademarks, like the symbol, the word, the phrase, all the brand of a business that is also legalized and cannot be used by others. So all these are intangible assets. They might have a value, or the value might not be clear or inexistent. And this is why these specific assets, even though valuable for the business, are not included in the general calculation of the balance sheet. Okay, only fixed and current assets are included. Intangible ones, even though important, are not part of this. So this is the balance sheet. In our next video, we will talk about depreciation, which is a higher level topic, but still important to consider and talk about when we especially get the balance sheet developed. So this is it for this part 2 of chapter 3.4. Bye-bye.